Whether you like it or not, there's no doubting that Tesla's stock is on a roll. Since the firm went public in 2010, its shares have increased by more than 20,000%, comfortably surpassing the market as a whole, routinely outperforming Wall Street's projections and transforming early investors into millionaires. Tesla is now the most valued automobile manufacturer in the world, having risen above and beyond Goliaths like Toyota and Ford. In today's video, we will discuss how Tesla is projected to hit $22,000 per share according to a multi-billion-dollar firm, ARK Invest. What does this mean for Tesla shares? How does this affect customers and potential investors? Let's find out. Investors and experts have reason to think that Tesla's production capacity will increase significantly in the next 5 years when new manufacturing sites open in Berlin, Germany and Austin, Texas. Many people believe that the demand for Tesla vehicles will continue to rise, particularly in China, where the electric vehicle manufacturer has already done remarkably well. Tesla also benefits from the overall excitement around electric vehicle stocks, as tighter emissions restrictions throughout the world present a clearer image of a future auto sector dominated by zero and low emission vehicles. It has consolidated its position as the dominating force in an EV market and is expected to develop significantly shortly. Today, we focus on the ARK Invest team and the new price targets that they've put out. ARK's investment team put up a post based on their research recently on what they felt Tesla's stock could rise to. At the time, they predicted that the company's shares could be sold at $4,000 per share in the next 5 years. So, before we go deep into detail, let's have a look at what the ARK Invest target means. The usual practice by Wall Street analysts is to forecast 12 months when giving their price markets for a stock, but in the case of Tesla, several analysts have been dead wrong for the past few years. Most analysts have even had a lot of trouble simply forecasting for a given Tesla quarter. In their defense, a forecast of most companies even 3 months from now would be difficult, especially with the most recent events and the COVID-19 pandemic. For Tesla, it becomes much harder to predict, as things like extra orders and such could affect the prediction of analysts. A lot could happen in a 3-month quarter. Now imagine attempting to predict for a year. That's 4 quarters. The only advantage is that you don't have to worry about some small fluctuations that could affect a quarter's prediction. So 12 months can be a fairly reasonable time for estimates, and you can get feedback on their predictions to come at the end of the year. ARK Invest focuses their research on innovative companies, and they use a 5-year period, which is pretty cool as they give you an idea on how investment companies forecast years ahead, as it is hard for investors to wrap their heads around these gigantic estimates of 5 years. ARK Invest's 5-year bearish forecast is $1,500 per share, and the bullish forecast is an amazing $15,000 per share. However, their expected value of $7,000 per share is not a price target, but simply a weighted average. ARK Invest assigns a certain percentage likelihood to each of their price targets and has come up with an expected value of $7,000. In a chart posted by ARK Invest, we see some purple dots. These purple dots indicate their expected targets for certain scenarios, and we will get into all of that, so sit back and get ready. The expected value of $7,000 is not a possible outcome if ARK Invest's price targets are correct. According to ARK Invest, these are the most important things to consider for Tesla to achieve massive growth potential, and this is what they use to come up with their price targets. The first is their gross margins, something that Tesla has been rapidly increasing, and currently they are about 21% at their automotive division. The low cost of the Shanghai factory and the higher cost of the Model Y, despite the Model Y costing the same amount in production as the Model 3, these two things have excited us about Tesla's gross margins. These two key factors have been principal to the rapid growth of the gross margins of Tesla. What makes it even more outstanding is how both the Model Y and the Shanghai factory are intertwined, and the fact that Shanghai would be Tesla's major export hub. These factors are expected to boost Tesla's margins to the mid-20%, if not more. The short-term goal is 25%, which is a low estimate for ARK's growth margin input, as the company predicts a 40% high. Another thing that could see Tesla's gross margins go up is the increase in production of their car models and batteries. The ramp-up of production of both batteries and cars could see costs drop exponentially. The second is capital efficiency. It's very similar to gross margins. If it costs Tesla $1 billion to build a factory, then that number is put into a balance sheet that gets depreciated over time. Depreciation expenses would happen every quarter and deduct a certain amount from Tesla's profits. According to ARK Invest's table, they show a $16,000 per unit vehicle, which shows up as an expense over time and reduces Tesla's gross margins. On the high end, they predict $11,000 per unit. ARK Invest says the high end is equivalent to the Shanghai Gigafactory capacity in China. Over time, we believe the factories would be cheaper to create as their expertise and experience in building them improve after each one. The third input on ARK's model is autonomous capability. ARK believes that there's a 70% chance that Tesla will not be able to create a fully autonomous vehicle and a 30% chance that they will. Within this 30%, they believe that Tesla would begin by charging $2.50 per mile, but would fall to $1 per mile. Musk predicted that Tesla vehicles would be fully autonomous by 2020, but it's 2022 already, and although there have already been significant upgrades to Tesla's self-driving, it's not yet fully autonomous, and it's still unknown when they would achieve this. But it doesn't affect ARK Invest's high-end predictions because Tesla has the most advanced self-driving tech and more information on it than anyone else right now, and orders are rolling in each day. They are definitely on track to get there first. Now, how would Tesla be able to hit that $22,000 per share mark? ARK Invest uses these key inputs we have discussed, gross margins, autonomous capability, and capital efficiency, and mix the probabilities of each element to determine their price targets. Looking at the table from ARK Invest, you would notice that the $7,000 price tag is not even on the list, but it is gotten from the summation of all the price targets, but it's not one of their outcomes. ARK Invest has some pretty cool names for each scenario in their price targets. For the scenario where Tesla goes bankrupt, with a probability of 1%, ARK Invest refers to it as the Black Swan. Another interesting scenario is the struggle bus. Here, Tesla is not able to achieve any element from any of the key inputs. It is not able to build factories efficiently, launch its autonomous network, or lower costs, but they reach a price target of $1,000 after 5 years. At least there's Wright's Law. Tesla can lower costs based on ARK's version of Wright's Law, but they can't build factories efficiently or launch an autonomous network and achieve a price target of $2,500. In the Golden Goose, an outcome with a 12% probability, Tesla can hit all the buttons right. They can lower costs, build factories efficiently, and launch their autonomous network. In this scenario, the price target reaches the $22,000 per share ARK Invest has touted. To be honest, we arrived at that figure after weighing the odds of 10 possible eventualities, including bankruptcy, so we've tried to be as fair and impartial as possible, said Wood, whose business manages approximately $11 billion in assets. The company also opines that in any scenario aside from where Tesla goes bankrupt, they predict Tesla would sell $10 billion worth of its stocks to boost its production. But this is unlikely as things are tilting towards Tesla hitting the Golden Goose scenario. ARK Invest also expects Tesla to issue incremental debt, tens of billions of dollars in certain cases, to increase manufacturing, with the issuance regulated by profitability and collateralized by fixed assets. Based on this probability matrix, our bear case predicts that Tesla will sell 3.2 million vehicles in 2024, substantially halving its share of overall EV sales from today's levels. Our bull case assumes that Tesla will maintain its around 18% market share and that a significant portion of its fleet will produce high-margin robotaxi platform fees. Do you think Tesla can hit the Golden Goose scenario? Comment below.